57%. Write that number down. That is the dollar's current share of global central bank reserves, and it is the lowest it has been in 31 years. Not since 1993 has the world trusted the dollar this little. And while the US is burning through political capital on the conflict in Iran and a trade fight that is going sideways, BRICS nations are not waiting around to see what happens next. They are already making moves, canceling dollar loans, issuing bonds in Chinese yuan, building a financial system that runs completely around America's. This video is going to show you exactly how far along that process already is, because most people have no idea how much has already moved. To understand how we got here, go back to the Ukraine conflict. That is the moment everything changed. When Biden sanctioned Russia and locked them out of the global dollar network, every finance minister and central bank governor on the planet had to ask themselves one question: could that happen to us? And, for most of them, the answer was yes. Biden did not stop at sanctions. He froze Russian assets outright. Europe joined in. Between the two of them, over $200 billion in foreign-held assets were locked up overnight. That is not a diplomatic message. That is a demonstration. It told the world that the dollar is not a neutral financial tool. It is a loaded weapon, and Washington controls the trigger. And here is why that matters beyond Russia specifically. Countries that have been storing wealth in US dollar assets for decades suddenly realize those assets are not truly theirs. They are held at the discretion of Washington. For every central bank governor sitting on a pile of US treasuries, that realization landed like a cold bucket of water. You do not need to be in a conflict with the US for that risk to matter. You just need to know it exists. And now, everyone knows. Here is what happened next in the markets. Historically, gold moved in a tight inverse relationship with US 10-year Treasury yields. Rates rise, gold falls. That rhythm held for decades. Then the Ukraine sanctions hit, and gold snapped that pattern entirely. Yields were climbing, the dollar was strengthening. By every traditional measure, gold should have been retreating. Instead, it climbed, month after month, regardless of what yields or the dollar were doing. That is the market sending a message the official commentary was not willing to say out loud. Gold was not going up because of interest rates. Gold was going up because trust in the dollar as a safe asset was cracking. That use of the dollar as a geopolitical instrument, and the world noticed. Before Trump came into office, he said something a lot of people in finance actually agreed with. He said sanctions were self-defeating. He called the weaponization of the dollar a mistake that would damage America's reserve currency status over time. People were cautiously optimistic. Then Trump sat down and immediately started issuing his own version of financial threats. Any BRICS nation that even mentioned replacing the dollar would face a 150% tariff. He said it directly. The BRICS currency discussion, which had been building for years, went completely silent. Trump even said publicly he had not heard from the BRICS states lately. He read that silence as a win. It was not a win. It was a delay. Threatening countries into silence does not change the underlying math that is driving de-dollarization. It does not change the fact that dollar loans cost twice as much as yuan loans. It does not change the fact that dollar access can be revoked at any time. It does not change the fact that holding US assets now carries a geopolitical risk that did not exist a decade ago. All the tariff threat did was push the conversation underground. And what is coming back up now is not talk, it is action. Here is what is actually happening right now. The new development bank, the BRICS Bank, is pivoting directly into Chinese bond markets. The stated purpose is to move project financing out of dollars and into Chinese yuan, the RMB. This is not a proposal on the table. This is a decision being executed. The Director General of the NDB stated clearly that Chinese bond markets are one of the highest quality funding sources in the world. And yuan-denominated loans, they said, create a natural match for projects that depend on Chinese materials and Chinese supply chains. That second point is the one most analysts skip past, and it is the most important of the two. Think about what is being built across the developing world right now. Power plants, factories, rail networks, solar farms. Now think about where the components for those projects come from. China, the steel, the solar panels, the turbines, the machinery, manufactured in China, priced in yuan, workers paid in yuan. So, If you are a country in Africa or South America taking a dollar loan to build one of these projects, you have created a structural mismatch before you even break ground. You borrow in dollars, you spend in yuan. The moment the dollar weakens against the yuan, your raw material costs in dollar terms go up automatically. Your budget starts bleeding. The loan that was supposed to cover the project no longer does. You go back to borrow more. It is a trap built directly into the structure of the deal itself. Borrowing in yuan eliminates that trap. Your loan currency and your spending currency are the same. The exchange rate risk disappears entirely. This is not ideology. This is just financial logic. Now, put the interest rate numbers on top of that, because this is where it gets genuinely striking. China's 10-year government bond yield right now is 1.8%. The U.S. 10-year Treasury yield is above 4.3%. That is more than double the cost of borrowing. Run that through a real scenario. You are a government borrowing $1 billion over 10 years to build a power plant. At 1.8%, the interest cost over that decade is manageable. At 4.3%, you are paying more than double in interest on the same principal. When you are talking about billion-dollar infrastructure loans, that gap can reach hundreds of millions of dollars over the life of the loan. For countries across sub-Saharan Africa, where every budget dollar is a decision, that difference is not marginal. That is years of health spending. That is a generation of education funding. It is a completely different economic outcome built into the financing choice alone. And why are U.S. yields so elevated right now? Because the U.S. deficit keeps expanding. It could exceed $2 trillion this fiscal year. When you are issuing that volume of new debt, you have to keep raising yields to attract enough buyers. The U.S. fiscal position is directly making its own debt less competitive in global markets. China is running lower deficits. Their bond market is attracting strong demand. The spread between the two rates is not narrowing. It is widening. This creates a feedback loop that works against the dollar. Higher deficits force higher yields. Higher yields make dollar borrowing more expensive for everyone. More countries look for alternatives. Demand for alternatives grows. The dollar's position weakens further, which puts more pressure on the deficit to offer even higher yields to attract what buyers remain. Round and round it goes. And right now, there is no policy on the table that breaks that cycle. Kenya is one of the clearest examples of what this shift looks like in practice. They have been converting reserves out of US dollars and into Chinese yuan. The logic has two sides. First, they stop draining their dollar reserves to service dollar-denominated debt. Those dollars stay in the country, available for imports and liquidity. Second, they reduce their exposure to one of the most dangerous scenarios a developing economy can face, which is a dollar shortage. A dollar squeeze does not sound like a disaster until you understand what it actually means on the ground. If a country runs critically low on dollar reserves, they cannot pay for imports. In many developing economies, energy imports are priced in dollars. Run low on dollars and the lights start going out. Food imports slow. Local currency inflation spikes because people are panic buying whatever is available. The whole economy goes into emergency mode. That is what dollar dependence looks like when it breaks. Switching to yuan financing significantly reduces that exposure. Kenya is not alone. They are just one of the clearest examples of a move happening across the developing world right now. Now, the demand data makes this even harder to dismiss. In January of last year, the new development bank issued 6 billion RMB in panda bonds with a 5-year maturity. Panda bonds are bonds issued inside China itself, denominated in yuan, drawing in Asian institutional investors with long-time horizons. The order book came in at over 8 billion RMB for a 6 billion RMB offering. More money was waiting to buy than there were bonds to sell, oversubscribed by billions. When that happens in a bond market, yields fall because buyers will accept less return just to get allocation. Yields came down on that issuance. Compare that to what has been happening with U.S. Treasuries, where yields keep rising because demand cannot keep pace with the supply being pushed into the market. More than 20 institutional investors participated. Central banks, insurance companies, commercial banks, long horizon institutions making multi-decade allocation decisions. And they chose yuan. Bank of China and ICBC underwrote the deal, capturing fees and relationships as China's banking system expands its global footprint, one bond issuance at a time. Every loan issued through the NDB every panda bond underwritten, every RMB swap activated is simultaneously building China's financial network and the asset base of its banking system. Every single one of these transactions is a brick in a wall being built around the dollar system, not with force, with finance. Here is something that barely gets covered in Western financial media. China has swap line agreements with more than 40 countries. Those agreements are collectively worth 4.1 trillion RMB, which converts to approximately 580 billion US dollars. A swap line is a direct currency exchange agreement between central banks. If a country is under financial pressure and needs liquidity fast, they activate the line, receive yuan, and use it to cover imports. And in most cases, where are those imports coming from? China. So, the swap line simultaneously provides emergency liquidity and routes the spending back into the Chinese economy. It is a self-reinforcing system. Compare that to getting a dollar swap line from the Federal Reserve. The U.S. does not extend those broadly. You need to be a G7 nation, a close American ally, or deeply embedded in the U.S. financial architecture. The list is short. And even getting on that list comes with obligations and political alignment requirements that most developing countries do not want to carry. China's network is wider, faster to access, and comes without the political conditions. And the speed matters. When a country is facing a currency crisis, time is the resource they have least of. IMF financing comes with months of negotiations, austerity conditions, and public scrutiny that can itself trigger panic. China's swap lines can be activated fast, bilaterally, and without a press conference. For a finance minister trying to stop a run on their currency, that difference is enormous. The infrastructure for a parallel financial system is not being planned. It exists. Now here is the moment from the tariff war period that most people missed, and it matters more than it got credit for at the time. At the Davos summit, as Trump was making noise about reclaiming Greenland and European economic responses, a Danish pension fund quietly announced it was liquidating $100 million worth of U.S. Treasury positions by the end of December. Reporters asked Trump directly, if European countries retaliated by selling U.S. stocks and bonds, would that concern him? His response was essentially, try it and see. He said the U.S. holds all the cards. That answer landed very differently in foreign finance ministries than Trump intended. Because what foreign holders of U.S. assets heard was not confidence. They heard a threat from the issuer of the paper they are holding. Think about what that actually means if you are a foreign institution. You hold U.S. treasuries. The President of the United States just told you that if your country makes a move he does not like, there will be consequences. Against the assets you already own, that is not reassurance. That is confirmation of exactly the risk that has been building since the Russia sanctions. Holding U.S. paper is now a political exposure, not just a financial one. When foreign institutions start selling dollars and treasuries in volume, the chain reaction is not complicated. More dollars hit the market. The currency weakens. U.S. assets lose real value. International holders take losses immediately and directly. People inside the U.S. feel it as domestic inflation. There is no version of large-scale foreign selling that lands softly for the American financial position. U.S. banks themselves are now forecasting further dollar depreciation over the next 10 years. The trade-weighted dollar is overvalued relative to what America actually exports. The economic output does not justify the current strength of the currency. And Trump's trade policies, despite their stated goal of fixing the imbalance, are not changing that underlying reality. The DXY, which tracks the dollar against 6 major currencies, including the euro and the yen, is expected to keep declining. Analysts are projecting a drop of between 5% and 10% from current levels through 2035. Think about what that means specifically. Oil is priced in dollars. Most global commodities are priced in dollars. As the dollar weakens, those commodity prices rise in dollar terms, which exports inflation to every country that imports energy. At the same time, U.S. exports become cheaper in foreign currency terms, which is supposed to help trade balance. But if foreign buyers are already reducing their dollar exposure and shifting to yuan-denominated trade, the export benefit never fully materializes. The U.S. ends up with the inflation without the trade rebalancing. That is the trap a declining reserve currency sets for the country that issues it. The dollar did pick up about 1% over the past month. That is a short-term safety reflex driven by conflict fears. When uncertainty spikes, some capital still moves into dollars automatically, but that reflex is weakening every cycle. The structural direction is still lower. Tariffs are not solving the trade imbalance. Spending is out of control. Look at the fiscal numbers directly. The U.S. deficit is running at roughly 6% of GDP. That is not emergency level. That is the baseline now. And annual interest payments on the existing debt have crossed $1 trillion a year. The U.S. government is spending more on debt service than on defense, more than on Medicare, more than on almost any other line item you can name. No foreign creditor looks at that trajectory and says, "This is where I want to put more of my long-term capital." When you are running a 6% deficit to GDP and paying $1 trillion a year in interest, you are broadcasting to every creditor in the world that the trajectory is not under control, and the world is adjusting its behavior to match what the data is showing. That brings us back to the headline number, 56.8%, a 31-year low. Central banks are rotating reserves into euros, Chinese yuan, and gold. This is documented in IMF data. It is not analysis or forecast. It is what central banks are actually holding right now. The diversification is real, and it is measured, and it is continuing. Two separate forces are driving it simultaneously. The trade war created uncertainty about dollar stability. The conflict in Iran created fear about what happens when you end up on the wrong side of U.S. foreign policy decisions. Trump going after BRICS with tariff threats, Biden freezing Russian assets, the ongoing Iran situation, they all deliver the same conclusion to foreign governments. No one is guaranteed to be safe inside the dollar system. The ones who can reduce their exposure are doing so right now. One of the most revealing signals of how serious the Treasury demand problem has become is where the U.S. Treasury Secretary has been looking for new buyers. When your traditional base of foreign central banks starts cutting allocations, you have a problem with no easy solution. Commercial banks have limits. Domestic buyers can only absorb so much. So, the new strategy is this: pull the digital asset market into the Treasury ecosystem. The pitch goes like this. Stablecoins are cryptocurrencies pegged to the US dollar. As the stablecoin market expands, issuers need to hold actual dollar reserves to back the coins in circulation. Those reserves need to generate a return, and short-term Treasury bills are the natural home. Officials have suggested that stablecoin legislation could generate up to $2 trillion in demand for U.S. government securities over the next several years. The market is real. The mechanism is real. Issuers do buy treasuries with their reserves. But here is what blows a hole in that narrative. Look at Tether. Tether is one of the largest stablecoin issuers in the world. Over $180 billion in coins currently in circulation. They hold enormous reserves to back redemptions at any moment. They do hold treasuries, but nearly 10% of their total reserve pool is now held in gold. And that gold position has been growing every single month since 2024, consistently, month after month. Read that clearly. The biggest stablecoin issuer on the planet, the company whose entire business model is built on the dollar, is steadily loading up on gold on the side. That is not a small hedge. That is a directional bet. Even the institutions being presented as the solution to the Treasury demand problem are quietly diversifying away from the dollar at the same time. And if Tether is doing it, you can be certain other stablecoin issuers and crypto institutions are watching and drawing the same conclusions. The pitch that digital assets are going to ride to the rescue of Treasury demand runs directly into this reality. The industry might buy treasuries with one hand while accumulating gold with the other. That is not the lifeline that Washington is looking for. Here is the honest summary of where things stand right now. The dollar is still the world's dominant reserve currency. It still accounts for the majority of global trade settlements. That part is true, but the majority it holds is smaller than at any point in the last 31 years, and every single force acting on it right now is pushing that number lower. The weaponization under Biden planted the seed. The tariff war under Trump accelerated the growth. The Iran conflict is adding fuel. And the BRICS financial infrastructure, the NDB yuan bonds, China's $580 billion swap network, the oversubscribed panda bond market, all of it is the foundation of an alternative that is no longer theoretical. It is operational. It is processing transactions right now. We may be closer than mainstream finance wants to admit to the dollar falling below 50% of global reserves for the first time in the modern era. Not a collapse. Just the next step in a sequence that has been playing out for years and is now hitting its stride. And the uncomfortable truth is that there is no single lever Washington can pull to reverse it. You cannot sanction your way out of a trust deficit. You cannot tariff your way back to reserve currency dominance. The only path back runs through fiscal discipline and consistent foreign policy. And right now, neither of those is anywhere near the table. Every month that the deficit expands, every new swap line China signs, every panda bond that gets oversubscribed, every country that converts reserves from dollars to yuan, the window for reversal gets smaller. The momentum is real, and momentum in global finance does not stop on a tariff threat. Will BRICS keep converting dollar loans to yuan? The trend and the math both say yes. How far does the dollar fall before Washington makes a real policy change? That is the question this decade is going to answer. Drop your take in the comments. Share this if it gave you a clearer picture of what is happening. Subscribe and hit the bell. This is Global Daily Wire. Stay safe.